Hi, everybody, and welcome back to video number 5 in chapter 4. When we left off, we were looking at significant non-cash activities. So you can have significant financing investing activities that don't affect cash, and they're either reported as a separate schedule, perhaps at the bottom of the cash flow statement, or in notes. Some examples would be we issue some common stock to purchase assets here. We convert some bonds into common stock. We issue debt to purchase assets, and we might exchange some long-lived assets. None of these transactions involve cash, so you're only going to find them if they're disclosed under full disclosure in our notes, usually. All right, so here's our statement of cash flows. Here's our adjustments. We had depreciation and amortization. We add those back. If we have gains, that's the non-cash item that's been added to net income, so we subtract that. If we have a loss, we add it just like we would with depreciation expense. And then again, we had an increase in receivables. Notice it's net of the allowance for doubtful accounts. And we had a decrease in inventory, so we're going to add that change back. And we had a decrease in accounts payable, so we're going to subtract that. So the sum of all those items, 91,000, and we add that to the beginning balance of net income to arrive at $411,750. Okay, so how would we do this here? Here's our net cash, our cash flow statement, and we had investing activities. We had the sale of plant assets. We purchased some equipment. We purchased some land. That involved spending, in total, $162,000. We also paid a dividend, issued some common stock, and redeemed some bonds, for which we paid $50,000. So the total of these guys were $30,200 here. So our net increase in cash was $279,000, added from this $411,000 from the previous slide. And our beginning cash position was $135,000, so our ending cash position was $414,950. And note the non-cash investing and financing activities disclosed here as a note to the statement of cash flows. And it said we purchased some equipment by issuing $50,000 worth of bonds. Okay, I really like the statement of cash flows. It's been an acquired taste. I think I initially liked the income statement because that seemed to be what everybody was interested in. That's how our bonuses were based and all of that. But then as I got more sophisticated, I realized that we can adjust that income statement by judgment that you would find as balance sheet items. But as I became even more sophisticated, I like the statement of cash flows because they tell me where the company is investing their money. Where are they spending their cash? And without cash, as it says here, a company will not survive. So we want to see a high cash flow from operations. That tells me that the company is able to generate sufficient cash to pay its bills. There's a low amount too. The company may have to borrow or issue equity securities to pay bills. That's not good. All right, so we have a ratio here, and we're looking here at liquidity. Liquidity means is there adequate cash, right? So we take the net cash provided by operating activities and divide that by the current liabilities. That gives us our current cash debt coverage. We really like to see a ratio near 1-to-1 or better, right? That indicates that the company can pay off its current liabilities from its internally generated cash flows, right? Okay, and so, and that ratio indicates a company's ability then to repay its liabilities from the net cash provided from operating activities without having to liquidate the assets that we employ, selling our seed corn, if you will. It is providing here a measurement of financial flexibility, really important. Okay, free cash flow. So free cash flow is the net cash provided by operating activities minus capital expenditures minus cash dividends. That gives you your free cash flow, the cash flow that's available to be used for purchasing investments, retiring debt, maybe purchasing treasury stock, or simply adding to its liquidity. That's the discretionary cash flow a company has. All right, let's take a look at this from the old Nestor company and its free cash flow that we previously calculated, the net cash provided by operating activities. We're going to back out our capital expenditures, those things that we spent to purchase long-lived assets, and we're going to subtract out our dividends. And that gives me $139,450 to be used to build my company and to make it more prosperous and profitable. Okay, let's put it into practice. Here, the Cassie Corporation's balance sheet at the end of 2024. We have a lot of items here. And the following information is available for 2025. We purchased some treasury stock. We paid some cash dividends. We declared them and paid them in this case. And a long-term investment in stock was purchased for $19,200. Okay, current assets other than cash increased by $34,800. Current liabilities increased by $15,600. We have depreciation expense on the building and $10,800 on equipment. Net income $66,000, bonds payable $60,000 were issued. In addition to the building, it was completed at a cost of $32,000. This is cash. And then patent amortization of $3,000. That's going to be a non-cash expense, of course. Equipment costing $24,000 with accumulated depreciation of $9,600 was sold for $12,000. So we would figure out the book value, what we sold it for, and that's going to be a gain or a loss. So we'll see that in a second. Here we're going to prepare the balance sheet and prepare a statement of cash flows. So let's see how we do that. While this is very small to see, perhaps I can make it a little bigger here. Here we have our current assets and our balance sheet. Okay. All right. Now we're going to determine the amount determined for current assets is computed last and is a plug figure. So that is the total liabilities less stockholders' equity is going to be how we determine that amount. Because the total asset amount is the same as the total liabilities and stockholders' equity, of course, the amount of total assets is determined, and therefore information is available to compute all the asset amounts except current assets. Therefore, we can determine that simply by deducting all the other asset accounts from the total to get to current assets, which we have here. Okay. So now our statement of cash flows looks like this. We have our net income. We had a loss on the sale of that equipment. That's the difference between what we received and what our book value was. Our book value minus what we received, we were short by 2,400, so that's a loss. We'll add that back. That's a non-cash loss, so we add that back just like depreciation expense and patent amortization. There is an increase in current liabilities. We add that back. There's an increase in current assets other than cash, of course, and that's 34,800. So the net cash provided here was 1,800. It jumps to the 67,800. Now the same thing for investing activities. Here we sold equipment for $12,000. That's this same $12,000 up here on which we computed a loss. Okay. And then addition of the building, we spent 32,400 on that and invested in stock. So in general, we had net cash used by investing activities, 39,600 here. And then our financing activities, we issued some bonds, we got cash for that. We paid some dividends, we paid some cash for that. We bought back some treasury stock, and consequently, we had a slight increase in net cash provided by financing activities. So our cash went up $39,000. We had cash at the beginning of the year of $5,000. So our ending cash was $44,000. If I go back to the balance sheet here, it doesn't give me doesn't spend cash out separately, but I will always check. Okay. Now we'll take a look at describing additional types of information that are provided. Notes to the financial statement. Here, that's an integral part of financial statement information. There's lots of items that in the interest of fair disclosure, we have to report by way of a note, and explains in qualitative terms information related to the specific financial statement items. It also provides supplemental data of the quantitative nature to expand information in the financial statements. And lastly, it explains restrictions, perhaps, imposed by financial arrangements or basic contractual agreements. For example, the bank may say, hey, you just borrowed $50 million from me. I don't want to see you paying any dividends till you pay me back, right? Now, you wouldn't see that in the statement of cash flows or the balance sheet. The only place you would find that would be in a note. Okay, also accounting policies. As you would well know, the way we apply some of our principles, bases and conventions and rules definitely affect how we present financial information. And of course, GAAP recommends the disclosure of all significant methods and principles, and LIFO and FIFO, double declining balance, would definitely have an effect on our amortized cost, etc. And the footnote is generally going to say summary of significant accounting policies. Okay, that looks like a good place for us to stop this video. And when we come back, we'll take a look at contractual situations. Until that time, bye for now.